Hi, everybody. Matt Dickin here with Strategic Wealth Designers. Thank you once again to tuning in to this next edition of Strategic Wealth Live, where we are going to be discussing the importance of getting a stress test done on your portfolio. So what I'm going to do today is I'm going to give, as usual, a little bit of an economic update as far as what we've seen since the last time we talked and we were here together on our webinar series. And then I will jump into the presentation. I'm going to try and keep it down to about 30 minutes, maybe 35 minutes or so here today. And as usual, you can ask us any questions that you might have, submit those to us. And if I don't answer them here in the presentation, then we will definitely make sure we reach out to you and get a answer to your question. So we still have some individuals logging in right now. So what we're going to do is show you a short video of some of our recent news appearances. And as soon as the short video is over, we will get started with today's presentation.
Viewers out there were set to retire in the next 18 months or so and have seen accounts drop by as much as 30%. That's huge. What do you say to this group and what they should do?
Yeah, the main thing is to try and take advantage of the opportunity that we have right now, because the market has rallied a little bit, to put a safety net underneath your portfolio. So if things get volatile again moving forward, you don't have to watch your assets go back down in value again like they have basically over the last 20 to 30 days. So individuals really need to take advantage of the opportunity we have right now to lock in their assets, because things could get worse as we start to see the unemployment numbers continue to go higher. Corporate earnings are going to be released next month, and all indications are it's not going to be good.
This stimulus bill, it was given credit for raising the market quite a bit last week. I don't know if that's the whole reason, but a lot of people gave it the credit. Is that going to last? Was it enough? And that all important question, is the worst over with the market? Can we say that?
Yeah, I think a lot of people was optimistic because this is a great headline. It is great that we're getting a $2 trillion stimulus. But if we think about the GDP for this country's over $24 trillion a year. So this is really only 1 month of that if we shut down all businesses, which is basically what's happened.
You're the guy that knows the most. So rapid fire, my friend. Number one, is there anything I can do right now or I ought to be doing with my retirement or my investments?
Number one, the big thing right off the bat is have a plan. We're in crazy uncharted times economically, and it's really easy to react to what happens in the market on a day-to-day basis. So the first thing would be have a concrete plan that you can stick with, because if you don't have a plan, it's like you're flying through retirement without air traffic control. And if you're flying without air traffic control, you may not get to your final destination.
All right, thank you for watching the short video that we had there. Like I was mentioning a moment ago, we're going to try and keep today's talk down to maybe about 30 minutes or so, and talking about the importance of getting a stress test done on your portfolio. And I'm really glad that you have tuned in to go through this experience with us here today, because I think that this is probably one of the most important things individuals need to be doing right now on their portfolios if they haven't done so already. Let me give you a brief background about myself and the firm here at Strategic Wealth Designers. We have quite a few of our existing clients and friends here viewing the presentation here today, but we also have some new individuals as well. So those that know me know my story very well, that I got a really early start in the industry because I started out when I was just about 18 years old, working for one of the major firms here within town. And was fortunate that I started to excel at a pretty early age. And because of that, they started to move me up into leadership and management type positions. And what I kind of realized after several promotions was the higher that I got within the organization, the more they would kind of sit me down and explain to me how things really operated there at the firm. And one of the things that we kind of realized over time was that everything that we were told to recommend to our clients and the products that we were out there suggesting really had nothing to do with whether or not they were going to be in our client's best interests. It had really everything to do with kind of trying to maximize the revenues and the profits for the company. And I got pretty discouraged with that, because I joined the industry to try and help people with their retirement plans, and I actually contemplated leaving the industry completely. But fortunately, I sat down, had a conversation with my parents, and they encouraged me. They said, well, Matt, rather than leaving the industry completely, or, maybe rather than leaving, this situation and going to another company where you may find yourself in a similar situation, why don't you just, start a company from scratch and set it up right from the very beginning how you want to. So if you want to avoid things like quotas and, pressure to push different products and things of that nature, then you can do that. So that's what I did. At this point, I was 23 years old, and that's when I founded Strategic Wealth Designers, because I wanted to offer individuals an option where they could work with advisors that were independent, not tied to just any one company, didn't have to worry about quotas and some of the other issues that we hear about all too often in our industry, and just really allow us to be free and make great recommendations for our clients just based upon what's in our clients' best interest. So we got the company up and running initially. Many of you have already heard the story. Initially, it's just my wife and I working in the office. Eventually, we got busy enough to where we had to kind of recruit my mom into the office out of retirement because she had already retired. My dad helped out for a while. And we slowly started to add some additional staff members. Today, we have 32 individuals that work for us throughout our various offices. We're headquartered in Louisville, Kentucky. However, we have offices in Lexington, Kentucky, as well as Cincinnati, Ohio, Indianapolis, Indiana, Denver, Colorado, as well as some of the surrounding areas to those large metropolitan areas as well. So over the last 17, almost 18 years now, we've been fortunate to help over 4,000 individuals and families with their retirement planning goals and dreams. And we have a tool that we're going to be discussing here today that we utilize often with those individuals. And again, it's a stress test that we always recommend everybody, whether they're a client of ours or not, to get, especially in times like we're going through right now where we have some volatility. Before I get into the tool and how it works, what I'm going to do is share with you some information, of course, that we are seeing right now as far as a bit of an economic update, because there's quite a few things that are going on in the economy right now that individuals are concerned about, and just some things that I think that you definitely need to be made aware of. Again, as I'm going through the presentation, if you have questions about anything that I'm covering, just be sure and submit the questions to us. If I don't answer it here directly in the presentation, then we'll make sure that someone does follow up with you and get you an answer to your question. But a few things that have changed since the last time we were together. Obviously, we now have tens of millions of individuals that are unemployed. Depending on whether you're watching this live or maybe the recording, of course, we're going to be getting new numbers on that tomorrow. It's projected that possibly as many as 45 million may end up finding themselves unemployed. Hopefully it doesn't go that high, but that's what the projections have been. It does look like a new stimulus bill will be passed again this week to give more money to the hospitals, as well as replenish the payroll protection plan that was designed for small businesses, again, defined as 500 or fewer, very busy and trying to get those loans processed. And those funds have now, hopefully, depending on when you're watching this, those funds have been replenished. Neiman Marcus this past week has mentioned that they're probably going to file bankruptcy, as well as some others like JCPenney. So you're beginning to see the true impact of the coronavirus, as well as the shutdown, begin to take hold. And then airlines have also announced that they're going to kind of keep most people on board until October 1st, where they are already warning employees that they'll probably do some pretty significant layoffs and furloughs, things of that nature. The reason why they're going all the way to October is because part of their stimulus plan or bailout plan, whatever you want to call it, dictates that they have to keep the majority of their employees on until that particular date. So I've also got some additional notes as I was getting prepared for today's webinar that I want to check and just make sure I'm covering everything. I saw a basically opinion by a well-known economist here recently that talked about for every one day that the economy is in this shutdown mode, it's probably going to take about 4 to 5 days to recover and get back up and running. So depending on what state you live in, you may be about 1 month into the shutdown phase or period that we're going through. And so what he's projecting is that, for every month, then it may take 4 to 5 months to recover and get back to normal. And unfortunately, there's going to be certain areas and sectors and jobs that just probably won't ever get back to normal. But that's kind of his projection. And I think that's probably a fairly fair assessment. because what you're beginning to see is even though some states are contemplating and even beginning to kind of reopen, it's going to be very, very difficult. It's not like just flicking a light switch and everything goes back to how it was a month or two ago. I saw an interview with a restaurant owner in Georgia, and they're one of the first states that are trying to go out there and kind of reopen. And of course, everybody has opinions on whether or not that's a good idea or not. But Georgia is one of the first states to go out there and try and do this. And so the restaurant owner had laid off the majority of his staff. They'd been doing a little bit of takeout business, but now if there's going to be in-restaurant dining happening at some point in the next week or two, he needed to rehire some individuals and hire more cooks and things of that nature. And he's having a very difficult time hiring some of the individuals that he laid off, because the way some of the unemployment benefits are working, you can actually make more money just staying unemployed versus going back and taking the job that you had prior to the crisis. So he basically is now saying that even if Georgia wants to open in the next week or two, his restaurant probably will not be able to open up fully until August, because he's not going to be able to staff it. Again, the time frame of August is because that's when some of these extra benefits of the stimulus package that was passed a couple of weeks ago, that's when those benefits are scheduled to basically run out. And so he's just finding it very, very difficult to compete with those higher pays for individuals basically to do nothing. So even though the economy may be starting to get ramped up again, it's going to be difficult to get businesses running again and at full capacity. And then, of course, we also have to debate, even if the restaurant is open and the economy is up and running, how many people are going to feel comfortable leaving their homes and actually venturing out. Another stat that I found interesting, Coca-Cola talked about their global sales were down only about 1% for the first quarter. So not too bad, all things considered. However, already this month, they've said that their sales are down about 25%. And I think that this is going to be a trend that we're going to continue to see. I don't really believe that the true economic impact of what we are all dealing with is truly priced into the economy yet and necessarily priced into the stock market. So that's why I'm talking about the importance of getting a stress test here today, that I'm going to share a little more information with you in just a moment. It's projected that up to 50% of small businesses, again defined as 500 or fewer employees, probably will not reopen at all. And since I was talking about restaurants, I heard recently probably about 70% of restaurants more than likely will not reopen. What's causing this is most small businesses on average only have about 20 days worth of cash. So if they're not making any sales, they're not generating any revenue, they can typically only survive about 20 days. And that's, of course, why you're seeing so many individuals being laid off. Now, there is a little bit of light at the end of the tunnel that I'll be talking about here in a few moments, but there's a lot of dangers that are out there right now. But of course, that also creates some different opportunities that we'll discuss here in just a second. But I think if you just kind of summarize everything on the economy as far as what we've seen in the last week or so, it really begins to feel like we're kind of fighting what I would refer to as three different pandemics. You're really fighting the virus and the health concerns there. You're fighting the emotions of this roller coaster that everybody's going through of, am I going to keep my job? Am I going to lose it? Is my family going to be safe? Are they going to get the virus? Things of that nature. And then the third kind of pandemic we have to fight is, of course, the financial impact of this. And again, like I was mentioning, I don't think the full effect is truly priced into the stock market just yet. So I'm kind of scared for a lot of individuals when you look at the financial scenario and a lot of individuals' investments. And that's why I'm covering this particular topic here today with you, because even though there are difficulties, there are certainly opportunities and things that you can take advantage of. And it's certainly not too late. I mentioned it last week that, the only thing we have comparable to what we're seeing right now is pretty much the Great Depression. And kind of the scary thing is, during the Great Depression, in order for the stock market to basically get from its high down to its bottom, it took about 3 years. It was kind of up and down. It took about 3 years. And right now, we are only about 3 weeks into this particular crisis and into this particular bear market. So we've seen a little bit of a recovery here recently in the stock market. And so I think right now is a really good opportunity to maybe get a second opinion on your portfolio and possibly readjust some of the investments that you're holding currently, because it's certainly not too late to do some things different. You haven't missed the opportunity just yet. So let me see if I can move where I am here on the screen so you can see everything. So what I wanted to cover in some amount of detail with you here today is our stress test software. And let me just talk with you a little bit about it before we go into the example I want to go over with you. So what a stress test is this. It basically is taking a look at how much risk do you have in your portfolio. So what it does is it compares, the level of risk that you're comfortable with versus what is actually happening within the portfolio. And once you have the stress test done, you can kind of identify what positions are okay to keep and just hang tight with and kind of try and maybe ride things out. And it may also identify what positions you have in your portfolio that you really need to do something different with, sooner rather than later. And then sometimes there's kind of a third category of positions that are kind of okay for now, but maybe we don't want to hold on to forever. So what that means, once you have your stress test done and you've made some financial decisions, what that really means is that you no longer have to worry about your money. There's other things to be concerned about right now, of course, but maybe we can eliminate the concerns as it relates to your financial well-being and your investments, so you can really focus on what truly matters. And that, of course, is your family, your friends, other loved ones, and helping both yourself and them get through this particular crisis that we're all dealing with right now. The software that we utilize is something that, for clients that have money under our management, it's something that we utilize almost on a daily basis. So basically what the stress test software does is it has over 100 years worth of historical data. And I've said often that although no two events are ever identical, almost anything that you can think of that can happen in the economy, which ultimately impacts the stock market, almost anything that you can think of that can happen, something similar has probably happened in the past. And of course, that's true with the COVID-19 crisis, because we have the Spanish flu that we can point to just over 100 years ago. So although no two events are ever identical, something very similar has probably happened in the past. So basically what happens is through the software program, we have over 1,500, I think it's actually close to 1,600 different stress tests that we can run portfolios against. So some of the things that we can take a look at are good scenarios, and then some of the things that we can take a look at are not so good. And when we run the stress test, what we're trying to do is see if we can find any real common denominators. Consistently, does a certain asset underperform or overperform? And although the stress test is not going to hit the numbers exactly, it's going to basically give us a good gauge and give us a good ballpark that we can deal with, and now we can make informed decisions. So when we run these for individuals, and some of you watching right now may have had us do this for you, when we run these, again, we have almost 1,600 different scenarios now that we can run. Nobody ever wants to see that many. What we do is usually pick maybe 2 or 3 or 4 things that may be in the news right now that individuals want us to run the stress tests on, or maybe they are concerned about. And when we run these different stress tests, we're not saying that this is going to happen. And we hope many times that most of these scenarios we look at that are bad, we hope that they don't happen. We're just kind of playing the what if game. What if it does happen? What's going to be the impact on my portfolio? Because a lot of times individuals are being told that they have a well-diversified portfolio, but in more cases than not, we're actually seeing that they're carrying far more risk in their portfolio than they ever imagined. So let me get the slides pulled back up here again and walk you through this a little bit. Now, that may be, depending on the size of your computer screen, you may have a little bit of difficulty in reading some of it. I'm going to try and not get too far into the weeds on this. I'm going to try and keep this as high level as I possibly can. And then before I get done here today, I will let everybody know how you can get one of these stress tests done on your portfolio or your 401k or wherever you might have money under management. Even if it's not with us, that's fine, as well as how you can maybe offer this to possibly your friends or family members or neighbors, things of that nature. So what we're looking at here, and again, I'm going to try and keep it as high level as I can, but I just want you to understand some of the logic behind the software and how it arrives at its numbers. Everything that happens in the U.S. economy is driven by different economic indicators. So, of course, they are things like the yield on the 10-year treasury? What is consumer price index, which is a gauge of inflation? How high or how low is that running? How is the value of the dollar doing? Things of that nature. So you have all these different economic indicators. What the software will do is it will take a look at where these economic indicators are now, and then based upon the scenario that we're looking at, what are the changes? What are the projected changes to these economic indicators? What should happen moving forward? Again, using over 100 years of historical data to kind of project what the changes should be on these economic indicators. And then we can drill down. Once we have those numbers, we can then drill down on individuals' specific investments and then show you what the projected impact would be on those. So I have three that I'm going to touch on briefly here today. What we have in front of you is an example of what if we went into some sort of a U.S. default or something of that nature. Now, we're not saying that this would happen. What we're doing right now is we're starting out kind of saying, playing the what if game. What would happen to our portfolios if this were to occur? So what could cause basically a debt cliff or a U.S. default would be things like Congress not cooperating, right? So let's say that we hit a debt ceiling and they don't cooperate and vote to increase the debt ceiling. We can debate whether they should do that or not, but the reality is if we hit the debt ceiling right now and they don't decide to raise it, well, then we could go into some sort of a default. So not saying that this would happen or will happen. Hopefully it never happens, but we just want to see how safe we are, how protected we are from this type of unlikely scenario. So on the screen, as you're looking at it, what we're looking at is the right-hand side first, okay? Let's take a look at the sample on the right-hand side. This is a real-world example of a couple's portfolio. Of course, we've changed the names to protect the identity on it. But this is a real portfolio of a couple working with one of the major stock brokerage firms here in town. And they were being told right now that they don't have anything to worry about in their portfolio. It's well diversified. They are about 18 to 24 months away from retiring. And they had lost quite a significant amount of money as the market went through its volatility starting last month, of course, right? And so they wanted to see, okay, where are we now? Okay, should we just ride it out? Should we wait for it to bounce back and get back to where it was? Or should we make some changes? Their current advisor, again, was telling them that they were fine. They were well diversified. They had a mixture of different mutual funds. You can see some of their names here on the screen. There was a mixture of different stock and bond mutual funds. And so because all their eggs were not in one basket, the advisor was basically claiming that, hey, kind of the worst is behind us. No matter what happens from this point moving forward, you're going to be okay. You're in it for the long run. The market's going to bounce back. It always does, things like that. All of those types of things can be true as long as you have enough time to make up for major market drops like we've seen so far, and we may continue to see as we move forward. So basically, taking a look at the stress test, again, on the right-hand side of your screen, this is a real-world portfolio of what these individuals have right now and how they are projected to react if we were to have some sort of a U.S. default. So if you can see it obviously there at the bottom of the page, it's showing that they have just over $1 million in the portfolio right now. But if we were to go into some sort of a default, 1 year later, it's projected that they would drop all the way to $507,000 because of how risky their investments are right now. And as you can tell, everything that's in that portfolio, if we were to go through the scenario, everything loses value. They don't have anything that would be going a different direction to kind of hold the value of the portfolio up. And this is based upon the numbers as of yesterday. So this is in addition to the drop that we've already seen in the stock market so far. Now, if you take a look at the left-hand side of the screen, this is a portfolio that we utilize here at the office, here at Strategic Wealth Designers. This is our most popular portfolio that we work with. And if you've followed us here on the webinars, you know that when the market started to get volatile, going back to really February at this point, we started to react. Okay, you don't panic. You don't just rush out and sell everything and move it to cash. You don't do those things, but you don't just bury your head in the sand and hope everything's going to work out. So we started to react. We started to adjust things within the portfolio. And so where we are right now is we've got some U.S. Treasuries. Of course, we always hold gold. We've got some stock market exposure, as well as a short position that we put in about 2 months ago. and we have some cash. So in our most popular portfolio, if we were to go into a debt cliff or a U.S. Default, rather than losing almost half of the portfolio, if these individuals worked with us, we would maybe move them into this particular portfolio. And instead of losing almost half of their assets, they would drop down about 16 or 17%. So not a fun scenario to go through, but this is kind of a worst case scenario if the federal government were to actually go into a default. Highly unlikely, but we just wanted to kind of see, well, what if that did occur, and is there maybe a better place to have these individuals positioned? The next scenario that I'm going to share with you is, what if, due to everything that I shared with you a few moments ago with the struggles of small businesses, and we're just at the beginning phases of the true economic impact of coronavirus on our economy and ultimately on the stock market. So what if we were to go into kind of a full-blown financial crisis at this point, similar to what we saw in 2008, 2009? So again, not necessarily saying that this is going to happen. What we're saying is, what if it were to happen? So if you focus on the right-hand side of the screen again, this is the current portfolio that the individuals came in to our offices with. If you look at the economic indicators, the current scenarios are similar to the previous U.S. default that we just talked about. The projected changes, if we were to go through this, are a little different. But as you can see, the bottom line scenario for this particular portfolio was basically the same. In this scenario, they would drop from just over $1 million down to about $510,000. So almost the same as if the scenario that we just showed, as if we were to go into some sort of a default as a country. Again, if you look at all of the assets that they hold currently, even though they're in a mixture of stocks and bonds and different mutual fund companies, they're all acting the same. And this is a common problem that we see often with individuals. They have a lot of different mutual funds or stocks or ETFs, and they think that they're diversified, but that isn't necessarily true. If everything's invested basically in the same manner, you almost never want all of your investments going in exactly the same direction. But this is a second scenario where we're seeing that is exactly what happens to this particular couple's portfolio. Once again, compared to our most popular portfolio here on the left-hand side of the screen, rather than losing over 40% of the assets, if we were to have another financial crisis, they would lose, kind of low single digits, which is something that is very easy to overcome and compensate for. It's when you lose 20 or 30 or 40% of your portfolio, those types of losses are extremely difficult to overcome and make up for. So another scenario where we're seeing similar results on this particular couple's current portfolio. One last scenario I'm going to walk you through, and that, of course, is COVID-19. So again, taking a look at where we are as of a day or two ago, what happens if this scenario continues to play out in the direction that it's going, similar to what we went through with the Spanish flu and all these different businesses that are going to be closing and the continued increase in unemployment? Well, what if we just don't manage this very well? What does the future look like? And again, this is from a couple of days ago, not at the beginning of this particular crisis, but where we are basically right now. Once again, on the right-hand side of the screen, the current portfolio does not hold up very well. Basically, all of its assets are headed in exactly the same direction. Here, they lose over 20%, so they go from just over $1 million to under $800,000. Again, on a portfolio that they're being told is well diversified, it's pretty safe, it's going to bounce back as soon as the economy recovers. Whereas what we're seeing here from where we are right now, the worst of it isn't necessarily over. We have a lot further downside potential than we do real upside opportunities right now. So once again, the portfolio doesn't hold up very well for somebody that's close or into retirement. On the left-hand side of the screen, once again, we have our most popular portfolio that we use as a firm. And under this particular scenario, if things still play out the way that they look like they're going to play out, if we weren't to change anything whatsoever, and we probably will make some adjustments, but if we just took a look at the impact of what we've done so far, rather than losing over 20%, again, we were down just around a 1.5% drop moving forward. So it has put the individuals in a much better position than what they were in originally. And they actually did take our advice, and they did move from the portfolio on the right-hand side of the screen over to the portfolio on the left-hand side of the screen And now they no longer have to worry about losing 20 to 30 to 40% of their assets, because we have true diversification. We have different assets that even in some pretty bad scenarios that we've laid out here that are actually performing fairly well and helping the overall performance of the portfolio not look so bad in some really bad scenarios. So again, not saying we're going to have another financial crisis. I'm not claiming that we're going to go into any type of a default. Hopefully not. But I think this scenario right here is obviously continuing to play out. And I think it's going to be with us in something that we're going to continue to struggle with for months, hopefully, not years, but at least months to come. And this, again, is on a portfolio that has already suffered pretty significantly. Again, if you go back and look at the portfolio on the right-hand side, this particular couple had already lost a fair amount of money. They didn't want to continue to lose. So this is the real value and the importance of getting a stress test done on your portfolio. When they came in, this couple had no idea that they still had this amount of downside risk built into things. Their advisor was telling them that they were fine, they were well diversified, the market was going to bounce back, nothing to worry about. Of course, that wasn't the scenario for an individual or a couple that is so close to retirement. It's not anything that I would ever recommend, but their current advisor was just recommending to them, just sit tight, don't worry about it. Once we were able to show them the actual impact and show them that basically all the assets were correlated, yes, everything wasn't in one bucket, but everything was kind of reacting and acting the same. They were motivated, wanted to make a change, and we showed them how we can make a change to give them a little extra layer of security and protection. So the reason why, again, I wanted to share this with you, and then I've got a couple more things I'll mention and I'll wrap up here today. The reason why I wanted to share this with you is, yes, even though the market lost quite a bit there in March, it has had a little bit of a bounce back. And this is a great opportunity to kind of put a little bit of a safety net underneath your portfolio, lock in some of the gains that we've seen over the last few weeks, because I do not believe volatility is done. I don't know that we've hit the bottoms or the lows on the stock market. I don't have a crystal ball, but you can make the argument that we're going to continue to have some pretty severe volatility moving forward. And the problem becomes, if you don't have the luxury of time to wait these types of things out, it can be detrimental to your retirement plan. So if you have 5+ years or 10+ years to go to retirement, maybe you arguably don't have to be as worried about it as somebody that's already retired or within 5 years of retirement. If you're in that scenario, I think you absolutely have to get a second opinion if you haven't done so already, and get one of these stress tests done, so at least you know the level of risk that you have. Because the average bear market usually takes about 14 to 19 months to go from its top to its bottom. Again, this bear market is only about 3 weeks old. So we have a lot further that we could go, a lot more volatility. Once the market hits its bottom, typically on average, it takes 4 to 7 years just to get back to even. So the total time frame we're talking about here is maybe a 5 to 8 to 9 year time frame before you get back to where you were in January or February. If, again, you just continue to do nothing and don't make any changes right now. And the only thing that's comparable to what we're seeing right now, of course, is the 1930s and the Great Depression. And during that time period, again, it took several years, but the market ended up falling a total of 86% from its high. It eventually recovered, but it took 16 years for those individuals to get back to where they were prior to entering into the bear market. So the main thing I'm trying to stress here is it is not too late to make some adjustments or do things differently. The last bullet point that I have here on the screen, the big concern that I have for everybody, and the reason why I wanted to get this information out to you, is because where we are right now in the market, if you've lost maybe 10 or 20%, some people have lost as much as 30% already, that is not fun. But there are things that can be done to recover from that. Things are tough right now, but in the middle of every difficulty, there are always opportunities. You are still in a position more than likely where you can recover from that. We can help get you there. If the market ends up falling a total of 50% from its high in February, that's going to be a little more difficult to recover from. Because if you lose half of the portfolio value from the top to the bottom, you now need a 100% return to recover from that. And that's not going to happen anytime soon. That's where individuals could potentially end up waiting 8, 9, 10, 12, 15 years just to get back to even. So we've had a really nice rally within the last few weeks. It is not too late. Now is the time to kind of lock in where we are You still want upside potential, and we can help you with that. But the main thing right now is to make sure that you get a little bit of a safety net underneath the portfolio. Major losses will hurt someone much more than big gains help individuals as they get closer into retirement. Okay, so a couple of slides left here. I just want to make a brief mention of what we will be talking about next week, and that's, of course, knowing and understanding your fees and expenses. We'll show you exactly how to determine how much you're paying in fees and expenses on your portfolios. Over time, these have a much bigger impact than you may think. And then again, if you're paying unnecessary fees and expenses, we'll show you some ways on how to avoid that. And then at last, if you would like to get the stress tests that we've talked about, you can click on the link to schedule a time to talk with one of our advisors, give us a call, or email us. The way it'll work is we need to have probably about a 10 to 15 minute phone conversation with you. Initially, gather some information, find out what different scenarios you would like to stress test the portfolio for, gather some information from you, and then we'll put it together and we can email it to you. Or if you want to do a Zoom meeting with us or even a face-to-face meeting, we're able to do those on a limited basis. We can get that scheduled after having just the initial 10 to 15 minute phone conversation. But this is something that we are offering complimentary. We're not charging anything for it. Sometimes we do charge individuals for these things, but I want as many people as we can in the communities in which we operate to get this type of information because I think that they need this information. So we are doing it on a complimentary basis. And so if you have friends or family members that you want to give this particular gift to or let them know about the stress test opportunity, contact us and let us know, or you can send them this webinar or have them visit our website and they can view the webinar at a time of their leisure. But what we're going to try and do is help as many as we can. However, we're going to have to limit it to the first 50 individuals that contact us each week. We pretty much got kind of a skeleton staff working in the offices these days, trying to do social distancing and things of that nature. So only the first 50 each week are we going to be able to give this gift to. So if you found this webinar on our website, if it's still up and running, it means that the offer is still good. By all means, give us a call and we're happy to provide it. Again, complimentary. Scary times right now, but of course, your finances do not have to be one of the things you have to worry about right now. But you do have to adjust and you do have to adapt things. At least get the portfolio done. Try and get a safety net put underneath the portfolio so you can stop worrying about money so much and get back to just worrying about the things that matter most, like friends, family members, and coworkers. Last thing, if you haven't done so already, please be sure to follow us on our Facebook page. We'll give you all the things that we're doing as a firm, some economic updates, as well as let you know what the topic is going to be for our webinars each week. Thank you once again for tuning in and look forward to seeing everybody at some point in the future. Thank you.